Trade settlements. Settled versus unsettled. A trade settlement is the official transfer of securities from the seller to the buyer in exchange for cash. The process confirms that the trade is legally complete. Most global markets operate on a T+2 cycle, meaning settlement occurs 2 business days after the trade date. However, some markets use T+1 or even same-day settlement. Until settlement occurs, the trade is considered unsettled. This distinction affects when a trader can use purchased securities or proceeds from a sale. A settled trade means the transaction is fully completed. The buyer owns the securities, and the seller has received the funds. An unsettled trade is still in progress, even though the trade has been agreed upon. During the unsettled period, traders cannot fully access or use the assets involved. Understanding this difference is crucial to avoid cash shortages or trade errors. Settlement knowledge impacts liquidity, risk management, and trading strategy. Traders relying on unsettled funds may overestimate their available cash. Selling securities before settlement can lead to penalties or rejected trades. Tracking settlement schedules ensures precise execution and avoids legal or financial complications. Unsettled trades exist because it takes time for the back-end systems to transfer money between banks, transfer securities between brokerage accounts, confirm details across clearinghouses. Even though everything is digital now, these processes involve multiple institutions and compliance checks. That's why most markets still operate on T+1 or T+2 settlement cycles. Settled and unsettled trades examples. We will begin with stock purchases. Now imagine you buy 100 shares of Apple on Monday. Until Wednesday, in a T+2 cycle, the shares are technically unsettled. You can see them in your account as pending or unsettled, but you can't use them to sell again without restrictions. If you tried to sell them on Tuesday, you might run into issues with your broker unless you have special trading privileges like margin access. Currency trade example. In the Forex market, settlement works a little differently. Suppose you buy euros with US dollars. The trade might execute instantly on your platform, but the actual delivery of euros to your bank account could take a couple of days. During that period, your trade is unsettled. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmentees.com and use code BLOG to receive 25% off your next purchase. Unsettled trades carry risks including liquidity gaps, unexpected margin calls, and regulatory violations. Free riding, a common violation, occurs when traders sell securities before fully paying for them. Misjudging settlement timings can also disrupt trading strategies, especially for active traders managing multiple positions. Awareness and careful tracking of unsettled trades prevent costly mistakes. Some traders, especially beginners, get tripped up by the concept of unsettled funds. If you sell a stock, the proceeds might appear immediately in your account, but they're often unsettled until the settlement cycle finishes. Using these unsettled funds to make new purchases can sometimes trigger violations, like a good faith violation in U.S. trading rules. This is why brokers constantly remind traders to be mindful of whether they're using settled cash or unsettled cash. Settlement timing shapes both short-term and long-term strategies. Day traders must know exactly when proceeds are available to reinvest. Long-term investors consider settlement cycles when rebalancing portfolios or withdrawing funds. Delays or misunderstandings can prevent timely execution, affecting profitability. Experienced traders integrate settlement knowledge into their planning to maximize efficiency. Traders gain multiple advantages from understanding settlement processes. They can accurately plan cash flow, prevent rule violations, and manage risk effectively. Clarity about settled versus unsettled funds enhances decision-making and builds confidence. Well-informed traders avoid penalties and optimize the timing of their trades. For long-term investors, settlement cycles might not feel urgent. But for day traders or swing traders, timing matters. If your funds are tied up in unsettled trades, you can't pivot quickly into new opportunities. For instance, if you spot a sudden dip in a promising stock but all your cash is still unsettled, you'll have to sit on the sidelines, possibly missing out on profits. This is why many active traders either use margin accounts to bypass restrictions or carefully plan their trades around settlement schedules. Conclusion: trade settlements are a core component of financial markets. Understanding the difference between settled and unsettled trades helps traders manage liquidity, mitigate risk, and optimize strategies. Awareness of settlement cycles, global variations, and associated risks ensures trades are executed smoothly. Mastering trade settlements is a key step toward disciplined, profitable trading. Thanks for watching.